What's up, everybody? Housing analyst Bill McBride correctly predicted the 2008 housing market crash. He did it by seeing patterns that led up to the crash happening. Not only did he predict the crash, but he also predicted the housing price bottom in 2012. Some people thought I was crazy when I argued house prices would fall 40% or more in some areas, but that is what happened. I also called the bottom for the economy in early 2009 and for house prices in 2012. Many of my readers thought I was a perma-bear. So today, we're going to take a look at two articles by Lance Lambert for Resi Club titled Renowned Housing Analyst Who Predicted the 2008 Home Price Crash Weighs In on the Current Market and Housing Market Outlook for 2025, 8 Early Predictions for Home Prices, as well as Redfin's latest housing market update. So let's dive right in. McBride's analysis started back in 2004 when he met a young girl at his gym who told him she just bought a $400,000 condo with no money down. He knew how much money she made, around $40,000 a year, so the numbers seemed crazy to him. So he probed further. She told him she had a 1% teaser rate for the first 2 years. Understanding just how risky this sounded, he asked her what her plan was after the 2 years ended. She said she'd either refinance or sell the condo at a profit. This really intrigued him, so he started to dig a little deeper. He started the Calculated Risk blog in 2005 to try to answer the burning question: why are lenders making loans that would most likely default, and how will this affect the housing market? Through his quest for answers, he started to predict that house prices would fall sharply in many areas, exacerbated by a flood of distressed sales, and this would eventually lead to a recession and a housing market crash. In 2005, he argued that inventory would be the thing that would tell the tale. And when inventory started increasing in the second half of 2005, he then called the top of the housing prices. Cut to today, and inventory is starting to rise again. In Redfin's latest housing market update, they report new listings are up 7.3% year over year, and active listings, or the total number of homes for sale, are up 18.3% year over year. Some markets are experiencing higher increases in inventory than others. In some parts of Florida, for example, inventory is now higher than 2019 levels. McBride thinks this is mainly due to high insurance costs. I think the primary reason inventory is up is the lack of affordable homeowners insurance because of destructive storms and rising sea levels due to climate change. Climate change might make some areas further north more desirable. I think we are starting to see the start of that trend. Redfin reports that the metros with the highest increase in new listings year over year are San Jose, California, up 29.3%, Jacksonville, Florida, up 21.2%, Las Vegas, up 21.2%, Miami, up 19.9%, and Phoenix up 16.4%. While the metros with the biggest year-over-year decrease in new listings are Minneapolis down 6.2%, Chicago down 5.4%, San Francisco down 4.9%, and Portland, Oregon down 4.3%. McBride said he is watching inventory closely, and he believes that this housing cycle will most likely resemble the time period of 1978 to 1982, a time of overheated price growth that saw spiked interest rates, strained affordability, crashed existing home sales volume, and yet no national home price crash, as opposed to the 2007 to 2011 national home price crash years. When Lambert asked McBride if he believes there is a certain level of inventory or months of supply in which he thinks national home prices will fall, he answered like this: the rule of thumb has been that house prices decline with more than 6 months of inventory. However, in 2022, we saw national price declines, as measured by Case-Shiller, with months of supply in the threes. He goes on to say that this was probably because inventory increased sharply in 2022, and some potential sellers were remembering what happened during the housing bust with cascading price declines. Months of supply, as reported by the National Association of Realtors, has been rising steadily, with the NAR reported months of supply at 3.7 months in May. And in Redfin's latest housing market update for the 4 weeks ending July 7th, they report the months of supply at 3.6 months, up 0.8 points from a year ago. McBride says he expects this measure to continue to increase and be over 4 months pretty soon, and to be above the 2019 levels in a few months, which would slow down home price growth significantly. He tells Lambert that we might see national price decline with months of supply above of 5 as opposed to 6, since most potential sellers have substantial equity and might be willing to sell for a little less. I am tracking this very closely. Even if there are some month-over-month home price declines in the second half of 2024, most analysts expect home prices to finish 2024 with positive growth. This would mark the 13th consecutive year of positive national home price appreciation. So where do these experts predict home prices to be in 2025? Some housing market experts are already making their predictions, and Lambert's Resi Club has put together a roundup of the full year 2025 home price forecast, with the average forecast predicting home prices will be up 2.5% in 2025. Goldman Sachs, who says home prices will be up 4.4% in 2025, is the most bullish, while Moody's, who still thinks home prices will go up but only by 0.3%, is the most bearish. Here's the whole breakdown. Looking out beyond 2025, Goldman Sachs believes that the national home price growth, as measured by the Case-Shiller National Home Price Index, will remain close to its historical annual average of increasing 4.5% between 1988 and 2023, while Moody's expects national home prices to experience a period of sideways movement. Lambert writes that the pandemic housing boom and following mortgage rate shock have stretched affordability relative to incomes. And I have to agree with him. And I think some markets are experiencing this now, especially the markets like Austin and Boise that escalated so quickly and so high. The local residents' incomes cannot support these inflated markets. Moody's thinks unhealthy affordability will constrain near-term home price growth. Goldman Sachs believes the lack of supply will outweigh affordability concerns. I think both can be true, which is why some markets are experiencing home price declines while other markets are still seeing home price appreciation. According to Redfin's latest housing market update, the metros with the biggest median sale price increase year over year are West Palm Beach, Florida, up 13.8%, Fort Lauderdale, Florida, up 13%, Detroit, up 12.9%, New Brunswick, New Jersey, up 12.8%, and Anaheim, California, up 12.2%. The metros with the biggest year-over-year median sale price decrease are Austin, Texas, down 1.9%, and Dallas, down 1.2%. Nationally, the median sale price is up 4.7% year over year, reaching an all-time high, and the biggest increase in 4 months. And the median asking price is up 5.4%, the lowest level in 3 months. The key metrics to watch in Resi Club's view is the labor market and active inventory, or months of supply. I would actually add home prices to this so you get a full picture of what's happening in your markets. McBride believes other indicators of what's happening in our economy are new home sales and housing starts. However, with existing home sales depressed due to a combination of limited existing home inventory and stretched affordability, new home sales and single-family starts have performed fairly well. This is because the home builders have been able to offer incentives, such as buying down mortgage rates to boost sales. So as long as we have this lock-in effect restricting existing home inventory, new home sales may perform better than expected, which could be a lagging indicator. Finally, Lambert asked McBride what he thinks is the biggest long-term headwind facing the U.S. housing market and what he thinks is the biggest long-term tailwind affecting the housing market. As far as headwinds, McBride said, probably the biggest headwind is restrictive policies that limit construction in many desirable areas. For California, this is a severe problem. Other headwinds include the lack of water in the Southwest and the impact of climate change, especially in some of the southern states. And as far as tailwinds, this is what he said. Perhaps the biggest tailwind, at least compared to other first world countries, is favorable demographics. Also, as climate change slows growth in certain states, it will likely be a positive for states with plenty of water and buildable land. I agree with him that states like Florida and other Sunbelt states, where housing costs have become so expensive with insurance and maintenance, and in some cases property taxes, will start losing more and more people as affordability is so strained. Something will have to budge, and it will most likely be home prices. But Florida is also a mixed market. Some parts are still getting escalated home prices, while other parts are getting major price declines. The consistency of downward trends across multiple Florida markets indicates that previously observed supply-demand imbalances and increased price cuts are now translating into actual price declines. This emerging weakness in prices, particularly in high-performing markets like Tampa and Miami, could signal the early stages of a market correction in that region, wrote Jason Lewis, co-founder of Parcel Labs. Nationally, Redfin reports a 6.5% share of homes with a price drop, up 1.8 points from a year ago. The median days on the market is 32 days, up 4 days from a year ago. 31.9% of the homes are still selling above the list price, down from 36% a year ago. And 41.1% of the homes sold in the first 2 weeks, down from 45% a year ago. The bottom line is we're going to see a lot of changes in our housing market in the next few months, with the NAR settlement rules taking place starting August 17th. Add to that an election year and a possible rate cut in September, and I really think the next few months are going to be very, very interesting. If you missed last week's video, we talked about how certain housing market experts are speculating that the laws of supply and demand may be finally catching up to current market conditions. In fact, some are now forecasting a correction or possibly a crash. When inventory rises faster than demand, prices have to adjust eventually, Realtor.com senior economic analyst Hannah Jones said. Increasing inventory levels are a sign that the market is starting to balance out. Inventory is rising in most markets in our country. Where I am here in the DC area, we are experiencing a mixed market. Some houses, even in the same neighborhood, are selling at different ways. One's going in multiple offers and selling way above asking, and the other is sitting on the market week after week getting price reductions. These times are really interesting. So comment below. Tell us what you think of what's happening in our housing market, especially where you live. Thanks for watching. I do appreciate it. Bye!